Thank you so much for joining us. Good morning and welcome to the 2016 Economic Outlook. I'm Tara Nelson. I'm the 6 o'clock anchor and executive editor at CTV Calgary, and I'll be your MC for today's event. I'm so pleased to be with you here for a second year in a row. I can safely assure you that this is the largest luncheon happening in Calgary today. This is probably the largest luncheon happening in Calgary this year. 1,550 people are here today, which is fantastic. I know you have lots of questions and you're looking forward to hearing our speakers today. This is a unique access to these three individuals, and we'd really like you to be a part of the conversation. We know that you probably have lots of your own questions, and as I was walking through the crowd, I saw lots of people with laptops and tablets and phones, and we know that you have access to that, so we're hoping for all of you social media gurus that you'll participate in the conversation today. You may not be seated with any of our three speakers today, but you have unique access to them simply through Twitter and email. So I would encourage you to start a dialogue with us today about what you're hearing. Use the event hashtag Outlook16, so hashtag Outlook16, and that will allow us to find your questions. It'll be your means of sending questions to Todd and Glen following their formal presentations. So tweet your question for either of those gentlemen to Outlook16 and then include the first name of the economist that the question is for, so Outlook16 Todd or Outlook16 Glen. You also can send us questions today for Governor Poloz, and you'll find that email address on the agendas that are placed on your table. So that address is communications@bankofcanada.ca. communications@bankofcanada.ca. And the Governor will answer questions related to his speech today as well. You may also have noticed a drop box as you came into today's event. Calgary Economic Development's corporate partner and official airline, WestJet, has very generously provided us with 2 tickets to anywhere that WestJet flies in Canada. The draw will be made at the end of today's luncheon. You have to be here to claim the prize, so someone will come around with the box to collect business cards if you didn't get a chance to drop it in as you came in. Also, you'll notice that there is a USB stick at all of your place settings. That will have all the material on it that's being presented today, including a video of the event, so please take that with you. That's for you to take away. You'll notice that the salad is before you. Please feel free to get started. Lunch will be served at about noon. This is a working luncheon, so please don't feel that you have to wait. Get started on your salad. We do have a very packed program for you today, so let's get down to it. It is my great pleasure to welcome to the stage the new President and CEO of Calgary Economic Development, Mary Moran.
Good morning, everyone. I think the people that aren't here are still probably having their morning coffee, as this is probably not only the biggest, but probably the earliest lunch that you've ever been to. But given the content, I think you're going to enjoy the entire 2.5 hours, and hope you can stay for the whole thing. On behalf of the board and staff at Calgary Economic Development, I'd like to welcome you to our 2016 Economic Outlook. And a very warm welcome to our distinguished economists, Glen and Todd. Thanks for joining us again. It's also a true honor for us to be able hosting Governor Poloz today. I'd suggest by the record high attendance, it's a good indication of how concerned Calgarians are about their city, their province, and their country. Before I get started, I also want to take the time to thank our sponsors. ATB, our presenting sponsor, and Suncor and Cresa, our supporting sponsors. I'd also like to thank MediaCo and Stampede. This event would not be possible without your support, and my sincerest thanks for stepping up and helping us deliver this extremely important content today. I'd also like to take the opportunity to thank our Action Calgary corporate partners, who, even during this economic downturn, have remained loyal and supportive. Now, more than ever, it is imperative we continue to tell Calgary's story across the country and around the world. My sincere thanks for your continued confidence in the work our organization does. Now, I don't want to preempt our guest speakers, but everyone in the room knows that after a year of great uncertainty, we are heading into an even stronger headwind this fall. With more anticipated layoffs trickling into other sectors, the unpredictability of oil price, downtown office space vacancies on the rise, and housing prices, well, I'm going to leave that one to the experts. And to top it off, we await the great anticipation of the outcome of the royalty review, climate change strategy, market access stance, and of course, the impact of the federal election. It is one of the most, if not the most, challenging times our city has faced since the mid-1980s. But as Winston Churchill said, if you're going through hell, then keep going. A true definition and demonstration of resilience. Last week, I had the privilege of attending the Global Business Forum, which had a prolific lineup of speakers. The kickoff speaker, Richard Dobbs from McKinsey, provided great advice to ensure companies, cities, and countries remain competitive and resilient in an ever-changing world. He stated three key themes that I'd like to share with the audience today. First of all, he said, focus on your external factors. Be curious and check the pulse of your competitive threats and risks continuously. Second, be agile. Don't get stuck in your old ways of doing business and be disruptive to respond to your ever-changing environment. And three, above all, remain optimistic and take a long-term view. As we reflect on the 12 months, some might suggest we should have anticipated the increase in shale oil production by our #1 trading partner. And perhaps that we should have anticipated the increase of world oil supply would outpace the relatively strong demand, both having a significant negative impact on the price of oil. Well, to that I say, isn't hindsight brilliant? But when I think about being agile and being optimistic, these are characteristics that are in Calgarians' DNA. We've demonstrated it through other cycles, and we certainly demonstrated it in our response to the 2013 flood. Taking a long-term view, we do have to be optimistic, and I'll get to this. But how agile we are going to be will determine what our future is. As my good friend George Brookman said, we can't stand still like Kodak, who watched technology emerge around them, and before they knew it, they had crippled their organization and crippled the city of Rochester. So why should we be optimistic? Well, in addition to having a young, highly educated, highly ambitious population filled with brilliant scientific minds that will help us rise out of this precarious position, the facts are, by 2040, the planet will grow its population from 7 billion to 9 billion. And 4 billion of that 9 billion will rise to middle class. All of those people will need energy. They'll need transportation, they'll need housing, they'll need heating, refrigeration, they'll need telephones and computers, etc. The energy pie will be bigger, and oil and gas will still be a big part of that pie. But it's important that when commodity prices improve, the industry emerges with a better narrative, a narrative that positions oil and gas as a technology industry, and that it owns the environmental, social, and economic responsibilities inherent in delivering quality of life to those 9 billion people. And yes, renewables will have a bigger piece of that pie. Some project as much as 25% by 2040, which means as a city, if we truly want to own the position of being a global energy center, then we need to be agile and we need to secure our position in renewables. Not to oversimplify it, but it will require those brilliant scientific minds to work together to create disruptive innovation to advance our position as a global energy center. And we know it's better that the innovation actually happens here than if it happens somewhere else. Protecting our role as a global energy center will allow us to stand with both feet firmly planted on the ground rather than on our back leg defending our key industry. Now, your question to me should be, what's Calgary Economics Development's role in all of this? Well, our organization takes great comfort in knowing that the discussion you hear in the boardrooms today about innovation, diversification, and efficiency are captured in the 10-year economic strategy for Calgary. A strategy which, by the way, is truly just a compilation and a prioritization of the ideas from the 500 business leaders, young and old, many of whom are sitting in this room today. The theme of the strategy, entitled Building on Our Energy, is about leveraging our strengths as individuals and as a community to accomplish three objectives. Embrace shared prosperity, ensuring everyone that comes here has an opportunity to succeed. 2, building a strong community, a place where we can attract the best and brightest, and they can see themselves living and raising a family. And finally, 3, advance sustainable growth through purposeful diversification. So what does advance sustainable growth through purposeful diversification mean? Well, it means we need to diversify within the energy industry, our markets, the production, source of energy, and the sources of energy. But we need to use our strengths in the energy industry in the areas of finance, law, and energy to support diversification, including exporting that expertise, but also supporting emerging sectors such as renewables, technology, and agribusiness. And of course, in an effort to diversify, the strategy also states that we need to further our position and leverage our enviable geographical location to strengthen tourism and film industries, as well as our position as Canada's premier distribution hub. Calgary Economics' job as the stewards of this community-wide economic strategy, they're simple. We bring people together to stay focused, we nurture Calgary's brand, and we advance growth and diversification. While at the same time, we travel abroad to find people, investment, and businesses that are interested in helping us achieve that goal. Calgary Economic Development knows very well it is impossible for our organization of 32, albeit passionate people, to deliver on this community-wide economic strategy. Calgary Economic Development requires commitment and strong collaboration of the private sector, all levels of government, nonprofits, post-secondaries, and our sister organizations in order to deliver the economic strategy. Although competing in the global economy is increasingly complex, it's difficult to stay optimistic when there's negativity swirling around us. How we collaborate will determine how agile we can be, and in turn, will direct our path and our future. On closing, I'd like to leave you with a thought that I hope inspires you as you listen to both the economists and the governor today. As Winston Churchill said, a pessimist sees difficulty in every opportunity, but an optimist sees the opportunity in every difficulty. Let's not lose sight of the long-term opportunities as we navigate through these difficult times together. Thank you very much.
Thank you, Mary. It's my pleasure to welcome to the stage now Mr. Glen Hodgson. Glen is the Senior Vice President and Chief Economist at the Conference Board of Canada. He brings 32 years of experience and a specialization in international, economic, and financial issues to the position of Senior Vice President and Chief Economist at the Conference Board. Mr. Hodgson is responsible for overseeing the board's macroeconomic outlook products, tourism, custom economic research, and he is the board's chief spokesperson on economic issues. We are very excited to welcome him and to have him deliver the Conference Board of Canada's 2016 forecast. Ladies and gentlemen, Mr. Glen Hodgson.
Thanks, Sarah. Well, now I know how a rock band feels when they get to play at the Saddle Dome. After starting in little clubs and smaller venues, I spoke to 10 people last Monday. in Ottawa, about 250 last Thursday, and now we have, 1,600 and growing? So great to be back in Calgary. Todd, you and I were here last fall. I don't think our oil price assumption at that time held up that well, did it? The world's changed a lot for Alberta, for Calgary the last year. I got about 20 minutes, and I'm going to go fairly quickly through a lot of information. But because oil matters so much, I thought it would start with oil prices. We've already seen the impact of basically half-price oil for the last year. Drillers have stopped drilling, investments dropped very sharply here in Alberta, but also in the United States. I'll show some of that. We think that going forward, stronger global growth is going to build a bit of a floor under the oil price, and prices will improve over time. It's going to take a long time. Frankly, I don't really expect to see $100 a barrel oil in my career as an economist. I think those days are now past because the rules of the game really change this year. And I guess, Todd, in our defense, we didn't understand how much the Saudis changed the rules of the game last year, was last November, in fact. So here's what's happened. Global demand for oil is still growing. Now, we know that the G7 leaders talked about the end of oil 100 years out. I definitely will not live that long. So my grandkids will probably be experiencing a very different energy mix in 2100. But right now, demand is still growing. It's growing in the emerging markets, it's growing largely in Asia, and China is the single biggest place where oil demand is growing. So let's not lose sight of the fact that there's going to be demand for oil for 50 years, 80 years to come, as we slowly transition to other energy sources. Production also, what's really happened the last year is the Saudis chose not to be the swing producer any longer in oil. They're not turning on and off the tap to try and maintain a price any longer. They're going to allow the Americans to do that. And if I can be rude in front of 1,600 people, those fracking Americans have changed the game. It's because of what you're seeing on the screen here, the takeoff in U.S. oil production, which is due to the fracking technology in the Bakken field, in Permian in Texas, and elsewhere. And you can see U.S. oil supply has taken off. The Saudis lost 1 million barrels a day market share sales in the United States. So they're rebelling against that. They're pushing back, trying to maintain their global presence. They're not prepared to turn off the taps any longer. And of course, that's having an impact on suppliers around the world. We're already seeing the impact, though, of prices going from 100 to a low of 38 at $45 this morning for WTI. The number of drilling rigs in operation in the U.S. has been cut in half compared to last year. And production is now starting to fall. It's still above where it was beginning of the year. And there's still a glut of supply in the world markets. But when you cut in half drilling activity, that is clearly going to have an impact going forward. So we think we're probably kind of at the bottom when it comes to prices. Maybe they'll slip back to $40, but on a going forward basis, we think prices will heal a little bit. And I was actually on the conference call with Minister CC a couple of weeks ago with the other forecasters. And that's the view of economists in Canada now, that we're seeing an improvement of price, but it's going to be a long road back. And the real driver is going to be the marginal cost of production by those Americans. I won't use the F word again. Which is about between $70 and $75 a barrel. So that may become the equilibrium price 3 to 5 years from now. So our courageous forecast, or foolish, is that the price will be something like $50 a barrel by the end of the year, $60 a barrel by the end of 2016. But you know what? Even in the last few weeks, we've seen oil prices move as much as $5 in a day. So this will not be a straight line. But because the drilling activity has stopped, investment's been pulled way back. We've seen investment cut here in Canada by about almost 40% in the oil patch. That will have an impact on new supply. And global demand is rising, which means that at some point there will be healing the price, but it's going to take a while. One slide on the world. I'm an international macroeconomist. My career was at Finance Canada, the IMF, Export Development Canada, where I actually worked with Steve for 3 years, now the governor. Very different story around the world. We haven't seen the impact yet of half-price oil. We're thinking the second half of 2015 will be better than the first half. So you're seeing that the bars are getting a little bit better than last year. 2016, again, will be a little bit better. But a very uneven story, a very kind of tumultuous story around the world. Japan going through structural reform with Abenomics. The Eurozone obviously dealing with Greece. Syriza got reelected yesterday. But stronger growth, we're actually seeing some of the weak economies in Europe like Spain and Italy growing again after 2 or 3 years of not having growth. North America, talk about in detail. Latin America getting clobbered by the fall in commodity prices. So Brazil, by far the biggest economy in Latin America, is now in a really deep recession, which may go deeper. with political scandal on top of that. So Brazil's in rough shape, really being affected by the rout in commodity prices. And then demand's still growing in the emerging markets, and Asia leading the way. I mean, we're actually doing a project on the ground in Indonesia, which will probably grow by 6% in real terms this year. So the story is very different around the world, but half-price oil should lead to stronger demand on a going-forward basis, stronger global growth, say between 3.25% to 3.5% next year. On to the US. The US is the single best good news story in the global outlook, in our economic outlook. We have a small econometric model at the Conference Board, 180 equations we use to predict the US economy. And the US is now growing at 3%. It lost the first quarter of the year. In the eastern United States, they called it the polar vortex. Here in Canada, we call it winter. But they had polar vortex, investment fell, demand fell. Well, the US is recovering very nicely. We're forecasting it to grow 3% the balance of this year, even a bit stronger into next year, so 3.1% into 2016. And all the bars are heading the right direction. In fact, I should have gone to Nike and gotten them to sponsor this sort of 2-minute US forecast, because you'll see there's a swoosh. Every slide is a swoosh. So let's swoosh into the US. The one thing I'll note is that the Fed chose not to raise rates last week, but rates are going to rise. Whether it's later this year, early next year, rates are clearly rising. That'll have an impact on our dollar. That'll put more downward pressure on the Canadian dollar by investors shifting into US dollar assets to earn the bigger premium. So here's the US story in about 2 minutes. That's not really a swoosh, because we were forecasting growth of nearly 3% beginning of the year. Bad first quarter, but now the US is growing at 3%, stronger next year. But here's the first semi-swoosh, the labor market. What really strikes me in this slide is that the US hasn't had 1 month of job loss for 5 years now. And in fact, the trend line is going up over the period. The US is now adding about 200,000 jobs to its economy every month. That's good. That's building confidence in the US recovery. It took a long time to get back there. I mean, the financial crisis is now 7 years behind us. So the healing has taken a long time, but America's back when it comes to job growth. Consumer confidence, that's a swoosh. I could put a Nike stamp on that one. Housing starts, another swoosh. Really good for BC, for New Brunswick, for anybody in Canada selling at the US housing market. Again, it's been a 7-year rebuild from the crisis. We're now at the point where housing starts are breaking through 1 million a year, maybe breaking through 1.6 million next year. A good news for us as an exporter, particularly with the dollar back to 75 cents. The American housing sector will now buy whatever we can sell into that market. We're going to be maybe challenged around capacity. I'll come back to that in the beginning part. Auto sales, that looks like a swoosh as well. In fact, that's part of the reason why the Detroit 3 are now getting reprivatized, why the state is selling its shares, because we're back to health in the US, North American auto sector. And the US consumer, unfortunately, that's a swoosh. That's arguably the single most important number in the global forecast, because the American consumer is 15% of the world. 70% of the US demand is right there, growing at 3%, even stronger next year. So this is a good news story. I can go on, but all the evidence points to a really robust US recovery now, finally. It's taken 7 years and lots of policy intervention along the way, but America's back. Maybe the one swoosh that's not quite there yet because of the polar vortex, which again we call winter, was business investment. We pulled our number way back for this year because investment actually contracted the US in the first quarter, but it's growing again, and you can see growth of around, about 8% for next year. Now that's very logical, because with the dollar re-becoming the reserve currency, the greenback is the reserve currency for the world again, US manufacturers and businesses have to invest to boost their productivity if they're going to compete with a strong currency. But we expect them to do that in our forecast. The one swoosh I don't like is net debt. And there's a long story here about Billy Bob Clinton and GW and Obama, but you can see what happens when you have a financial crisis breaking out and you have to bail out the banks, bail out the auto companies, add nearly $1 trillion of stimulus. Good news is the deficit's coming down, but it never actually gets back to zero on its own. So the next president, whoever she is going to have to deal with this, because the current Congress won't. But all in all, a good news story for the US. On to Canada. The Canadian story is quite different. We're an oil exporter. We've been really clobbered by the fall of commodity prices over the last year. We've marked our forecast down every quarter. At the Conference Board, we run our forecast machine, basically, a huge model every quarter. We've dragged down our forecasts. I think I said 2.7%, Todd, last fall for this year. We marked it down, and we're down to kind of 1.2, 1.3% now for Canada. But it's not evenly shared across our economy. You clearly are feeling it here in Alberta more than any place else. We've seen that in the revenue numbers for business. We've seen that in the investment numbers. We're hoping that exports, with the dollar back at 75 cents, with a U.S. recovery, exports will drag us forward. So our export forecast is positive as kind of a source of energy for our economy. But business investment is very weak. It's a real trouble spot for our economy. Labor markets are going to tighten across the country because of aging demographics. You won't feel it here quite as much as you might have a year ago, but even in Alberta, you're going to feel the impact of this as the baby boomers get ready to retire. And ultimately, the policy mix we put in place, mix between monetary policy, which the governor controls, and fiscal policy, which whoever the next government is in Ottawa can think about the path for fiscal policy. Also, the new government up in Edmonton is thinking hard right now about the right fiscal policy for Alberta over the next 3 to 5 years to ensure that growth actually gets restarted on a sustainable basis here. So quickly through Canada, there's our forecast. Not a great number for this year. We did have a technical recession first half of the year, although we did have growth in June nationally. And I'll take this apart for you, growing at about, what's that, 2.1, 2.2% for next year. So recovering economy, but not the kind of robust growth we'd all like to see. The world of 3% growth has now been left behind for Canada. We've become a 2% growth economy. That's the new normal that we're going to live in. Even if oil prices went back to 80 or 100 bucks, I think we're kind of stuck in a world of 2% unless we can spark it through innovation and productivity. But we haven't found a way to do that. So quickly through Canada, we do a very detailed provincial forecast. And I wanted to share that with you right up front because I was the awful economist who used the R word back in January, talking about a recession in Alberta. And the previous government wasn't very pleased with that. But you know what? That's the way sometimes you have to call it the way you see it. And my job's not to make people happy. It's to speak truth to power. So there's our provincial forecast breakdown. You can see recession in Alberta, also in Saskatchewan, which is also dependent upon hydrocarbons, a little bit in Newfoundland, and then on a going forward basis, we actually have raised our forecast a bit in central Canada, BC having a really good year because of the US housing recovery. What you guys probably care more about is next year. We are forecasting a turnaround for Alberta, so we expect probably in the first quarter of next year growth to return to the Alberta economy, growing at about 1.5%, and you can see the distribution. Newfoundland is impacted by the loss of investment this year. They haven't added any new capacity. And the production from the offshore wells in Newfoundland doesn't last long. So as they bleed away, if you don't replace that, you can actually have a negative impact on GDP in the province. Taking you through the Canadian story, we've been clobbered this year by the fall of raw material prices, by global commodity prices, down more than 15%. That's money in our pockets. We've lost $40 billion of revenue in the oil patch alone because of what's happened to commodity prices. And because we're an oil exporter, clearly we've been affected as a national economy. We're expecting prices to improve a little bit. So the oil price improvement, you can see maybe some improvement, things like copper prices, watching where the global trends are going. By the way, the China story for me has been vastly overblown. I think China is quite capable of growing on an ongoing basis between 6 and 7% for the next few years. So we'll get through the fear factor we all experienced last month and see that there will be a bit of a floor built under commodity prices, but not going back to where they were over the last decade. This is what's happened in the oil patch across Canada. Investments down by between 35 and 40% in line with prices. We also have a very sober investment story for the national economy. The bar going down for 2015 isn't great, but what really troubles me is the fact that private investment is so weak over the last 3 years, and in fact will be weak going forward. This is not good news if you're trying to retool your economy to stay globally competitive, to become more productive. And there's always a story. Every year you can tell, well, it was because of this, because of that. But look at the trend over 4 years. That's not a very good news story. And this, by the way, is after all the efforts to improve the corporate business tax environment. We really haven't seen the response. Firms are still sitting on more than $500 billion of cash, about $550 billion of cash in corporate balance sheets. I'm hoping that the US recovery and stronger exports will be the magic key that unlocks the vault and gets that cash to use. But right now, it's not, this is arguably the least optimistic part of our forecast. It's a very, very weak private investment. Short-term interest rates, of course, the governor cut rates again to try and ensure that our economy doesn't fall back any further. The Americans are going to raise rates at some point, whether it's this fall or early next year. The real story is that the interest differential will be limited and it's starting to widen, which will probably put more downward pressure on our currency. In fact, I've got in the next slide, what's the course for the dollar over the next few years? Well, you can see the close correlation here. The yellow line shows you oil price over time, and the blue bar shows you the value of the dollar average over the year. And you can see the very close correlation. So basically on a going forward basis, we have a race between what's happening with oil prices. Will they recover to $50, to 60, to 70, to 75? And how long will that differential exist between the Canadian and US interest rates? Because the oil price going up is good, drives the dollar up. The interest rate differential will drive it the other direction. I wouldn't be at all surprised to see the dollar fall further when the Americans do raise rates to something in the low 70s, maybe even 70 cents, because people will asset switch into US dollar assets, and that'll put downward pressure on the dollar. But if you buy my oil prices forecast or assumption, then you should buy a Canadian dollar gradually increasing in value over the coming years. Export volumes I mentioned already, that's the good news story in our forecast, although not huge numbers. You can see that the volume number is only 3% growth this year, 4% next year. But at least with the $1.75, we have the opportunity to kind of export our way back to more robust growth. The challenge, of course, is that I've already mentioned the capital stock is limited. We're not growing our capital base. So there are some sectors that have spare capacity, there are a lot that don't. Maybe, again, this will be the spark, the opportunity to sell more stuff to the Americans that'll get business in Canada investing in a more robust way. Briefly on labor markets, you can see that we're kind of crawling back to what economists call the natural rate, which is full employment without inflation. Todd, I gave a lecture last week where I was trying to explain Nauru to a room full of labor negotiators. It didn't really go well, so I'm not going to even try here. Just to say that Alberta is still pretty much at full employment, as economists would see it. There has been a bit of adjustment in labor markets, but there hasn't been a massive bleeding of jobs. There's been job loss, obviously, but it's not the kind of route that you could have expected when your dominant product sees its price fall in half. Employment growth. One of the really interesting phenomena this year is that although our economy contracted in the first half of the year, we added almost 100,000 jobs, which I guess is evidence for me that the impact is not being felt evenly across the national economy. I've seen a few media releases about firms here in Calgary, for example, that are choosing to cut salaries rather than laying people off, which tells me that they're very much aware this is a tight labor market going forward. If you lay those guys off, you may never get them back. So firms are kind of thinking through the strategy to have a sort of an intact business model going forward as oil prices recover. We expect job growth to keep moving forward at about 1% annually. Compensation, wage increases down a little bit because of the falling commodity prices. You can see that our inflation forecast, which is the yellow line, is forecasting inflation of only 1.5% this year, picking up again next year because with the dollar having fallen in value, we're all now paying more for imports. And I've written a lot about the impact of the exchange rate on the economy, and I look at things as kind of a value chain. And we're exporting more, but we're also importing more, for example, in a sector like autos. So I don't automatically cheer when the auto sector becomes a dominant exporter because it's also a dominant importer. We only add about a third of the value of the car in Canada. And of course, as consumers, we're all paying more for imported stuff. So it's a very mixed story for me. But on a going forward basis, we do think nominal wages will increase a bit more next year. Consumer confidence in Canada, not as robust as the US. In fact, it's pretty much flat over the last year, 18 months. People are aware of the fact that our dominant exports have been hit in terms of the offtake price. And so they have a more muted kind of sense where our economy is going. Consumer spending also being affected by this. So you roll all this together, we have job creation but not strong. We have consumer confidence kind of flat. People are being very cautious. And so we have consumption growth for Canada growing at only around 2% and a bit better next year. Now, the thing that everybody wants to talk about is this, which is the level of personal debt. And it's true that we're now number 3 in the world, sort of all-time high for Canada. Personal debt as a share of income. Now, arguably, people, though, are being rational because they've never been able to borrow money at a lower price. So the thing that I focus on is debt service. How much of your income is actually paying interest on that debt? And that's never been lower. So in fact, we have not been calling for bubbles in housing markets. I'm not overly concerned about the high levels of personal debt. We need a strategy, a 3 to 5 year plan to work our way through this. But if interest rates aren't going to rise for the next year, which is our view, we don't have to be all freaked out about the level of personal debt. We have to come up with a plan to deal with it, recognizing that there will be individuals who are underwater, who've taken on too much debt in the search for assets. One of the key drivers for the debt level is the housing market. And again, I've been saying for I think 6 years now that we were going to have a soft landing, not a crash landing, not a bubble. The relationship between the line here, which is household formation, people actually getting ready to buy a house, and starts is quite revealing. We've actually been building below household formation rates for 3 years now. And now housing is very local. There's no such thing as a national housing market in any country because, well, maybe theoretically you could live in Calgary, work in Vancouver, but it's a long drive or it's a long flight every week. So it's a local phenomenon. I do worry about high-end condos in Vancouver because they're tied to the Chinese market. I worry about overbuild in Toronto. Prices are adjusting here in Calgary, as you would expect with an economy which is going through mild contraction. But for the most part, we don't expect bubbles to appear. We don't expect there to be a collapse in housing prices. They may adjust a little bit here in Alberta, but as the economy grows again, builders have stopped building. There will be adjustment on the supply side. That should stabilize the market. Todd, I hope you're going to talk more about this in your comments. Maybe my last comment is I didn't put in a city forecast for Calgary, and I don't want to scoop the conference board. We're going to put out a media release later this week giving our Calgary forecast. But fair to say that Calgary's growth pattern will be much like Alberta's. So don't be at all surprised to see a mild contraction this year in the Calgary economy and a recovery next year, hopefully starting in the first quarter of the year. Implications, well, we're now the 2% economy in Canada. The story changes every year, but the results are the same. We end up with growth of around 2% because we've been deleveraging. There are big differences between regions. You're the most affected, but you also have an income level. People in Calgary shouldn't forget that the average Calgarian is a third richer than the average person in Montreal. So we have a stronger base to start from. Mary, I like very much your comments about diversification. Hopefully we'll have a chance to talk about that in the Q&A period. But 2% is the new normal. Hopefully Alberta can get back there in the coming year. Thank you for your attention.
Thank you very much, Mr. Hodgson. We want to remind you, if you have questions or there were things that you thought of as you were listening to Glen speak, please tweet that to us. Hashtag Outlook16Glen or Outlook16Todd if you have questions for Todd. And it is my pleasure to introduce Todd Hirsch. Among many things, Todd is ATB's financial chief economist, and he provides economic commentary for several Canadian media outlets. He is a regular columnist for the Globe and Mail. He currently serves on the Alberta Economic Development Authority, the University of Calgary Board of Governors, and is the chair of the Premier's Council on Culture. Todd has worked as an economist for over 20 years and also writes an economic update called The Owl that is sent to thousands of subscribers around the world every day. Please welcome Mr. Todd Hirsch.
Well, thank you very much, Tara, for that. Oh, there we go. Wow. Thank you very much for the kind introduction, and thank you for Calgary Economic Development for inviting me back for a second year for this lunch. It's a real honor to be here. I'm always vaguely surprised that people invite economists at all anymore to events like these, especially cocktail parties. We really just bring a lot of bad news and make it a bad party. But it is very nice to be here. Always an honor to share the stage with Glen Hodgson, who I have a lot of respect for. I always learn so much just listening to his presentation. So great to see you again and present with you. Back in June of 2015, Adam Legg, who's probably in the room from the Calgary Chamber of Commerce. Where is Adam? Somewhere. There he is, yes. Adam will know what I'm talking about. In June, Adam and I shared a stage, and we were giving a presentation to ATB Financial's some leadership team, a leadership retreat, and we were both talking about the outlook for Alberta's economy and Calgary's economy. And back in June, Adam was maybe a little bit more realistic about the situation, and I was the optimist. We were kind of doing a little he said kind of thing, and I was playing the optimist role in that presentation that day. Well, I liked Mary's definition in her opening remarks about the optimist, but the definition I like of an optimist is somebody who doesn't have all the information yet. Yeah, and that was kind of me back in June. I got a lot of information over July and August and into September, and now maybe I've been a bit of a convert to Adam's way of looking at the world. You know, the situation for the province and for the city, it has changed, even since June, with a weaker oil price environment and a weaker outlook for the global economy and some of our main trading partners. My presentation, as you can see, Losing Balance, Regaining Control, an Alberta Economic Forecast for 2016. I love the whole image of things being in balance. When things are in balance, it can be a beautiful thing to behold. Whole cultures and religions are all kind of focused on bringing things into balance around harmony, the yin and the yang, and tensions pulling in different directions. But when it all comes together, when things are in balance, it's actually quite remarkable. Sometimes things can be, they can appear to be in balance, but in fact, there are some serious imbalances growing. Often the balance is just an illusion. And it's this theme of balance and things being out of balance that I want to focus on in my comments about what's going on in the global economy, but specifically what's going on in Alberta's economy. Because I do think there have been some serious imbalances that have developed in Alberta over the last 5 years or so. And we find ourselves in 2015 in a situation where things are rebalancing. Sometimes when things are out of balance, it can be quite funny. I'm sure this donkey doesn't think this is very funny. And I think it's fair to say that there's a lot of people in Alberta right now who don't think what's going on in the economy is very funny either. There is a heightened sense of anxiety, a heightened sense of nervousness, worry about job loss, all of those things which are very normal and very common. We in Alberta, we see these cycles happen over and over again. But as we move into the fall of 2015, I think we're now and again in a heightened sense, a period of heightened anxiety about just what is the economy going to do? Is my job going to be around? So what I want to do is focus on this theme of imbalance and things coming back into balance. I'm going to just touch on a few places around the global economy. This is one of the benefits of presenting with Glen, because he does all the heavy lifting with the data and the numbers. So I'm not going to repeat what he said, but I'm going to touch on 3 parts of the global economy and talk about imbalance there, because those 3 parts of the global economy have had a large bearing on Alberta's economy and our primary resource in the petroleum sector. And then, of course, I will return to talk about Alberta's economy specifically, the imbalances that have been building, and I'm going to conclude then with 4 things that I think they need to fall into place before, in fact, Alberta's economy can regain some balance and regain some control. So let's start with our little tour of the global economy. Let's talk about Europe, first of all. It's always a big ball of crazy over on that side of the pond. Interesting to watch, I suppose. And we saw the 3rd round of bailouts extended to the Greek government back in, was it May or June of this year? I think it was May. A 3rd round of massive bailouts. But as you probably are aware, this didn't solve the problem for Greece. It didn't solve the problem for Europe. It papered over the problem once again. It averted, a major catastrophe or a crisis, a run on the banks and the financial systems in Europe. So it sort of dodged another bullet, but it didn't solve a problem. Not for Greece, not for the European Union. And that's why I think things in Europe still remain dangerously out of balance. Now, right at the moment, very sadly, Europe is sort of consumed or focused on the Syrian refugee crisis, which is a very serious thing. And I think their eyes have been diverted a little bit from some of the fiscal and financial challenges they have. But I do think in 2016, the financial problems in Europe, particularly around Greece, are going to come back again as a destabilizing factor. I don't think that story has really changed. So unfortunately, I think 2016, we can look forward to some imbalances on the global economy once again coming out of Europe. Let's talk about the Chinese economy. Now, I tried really hard online to find some pictures of some Chinese acrobats sort of falling over and being out of balance. Turns out there aren't any photos of Chinese acrobats out of balance. Every photo, they are perfectly in balance like this. So here's a nice picture of some acrobats demonstrating perfect balance and perfect harmony. But I think also it's fair to say that the Chinese economy is not in perfect balance in 2015. And this is where we are seeing some impact on the commodity market, particularly on world oil prices. It's long been an article of faith for economists and investors that China is going to continue to grow at a more modest rate, coming off those double-digit growth rates of a decade ago, but growth of around, 7 or 8%. It was long assumed that China, of all countries, was going to continue to be that strong engine of the global economy. Remember back about 4 years ago, we used to talk about the BRIC economies? I too would have been one talking about the BRICS, Brazil, Russia, India, and China. Well, we're really just down to the IC economies, and we might just be down to the I economy, India, because even China has been showing a lot of strain. And it's been over the last couple of months, in fact, that economists' faith in China as an engine of growth has really been tested. And that's one of the reasons why we saw oil prices. They were hovering back around $60, $61 back in June, back when Adam and I were presenting together. But then the cracks in the Chinese economy and all the volatility in their stock markets, especially in August, really started to test our faith in the Chinese economy as being a continual source of growth for petroleum. And we saw those oil prices swoon down as low as $38 and now still really volatile. So I do think China's economy will suffer more volatility in the last half now, or the last quarter, I guess, of 2015. And probably we can look forward in 2016 to some more volatility and uncertainty coming out of China. Finally, I want to talk about the United States. Well, as Glen mentioned, the United States, it is the bright hope, the beacon of hope for the global economy in 2015. And the United States, their economy is in balance, but just like this guy here on his motorbike, or on his mountain bike, he does have still the training wheels on. He's not yet 100% confident that he's going to be able to maintain balance. And by the training wheels, I'm really referring to the US Federal Reserve and their decision to not raise rates in September. Yeah, we're in balance, and we got 5% unemployment and 200,000 jobs a month and consumer confidence and housing starts, but we're still a little nervous. We're worried about what the Chinese market volatility might mean for the United States, or what instability and turmoil in the Middle East is going to mean for the United States. So they're keeping those training wheels on, at least for the time being. Now, my guess is they will eventually take the training wheels off in December, and they will raise that Fed rate by 25 basis points. But who knows, if there's more instability between now and then, the U.S. could keep the training wheels on longer. I think they probably could have raised rates in September, and they probably should raise rates in December, but we'll have to wait and see how the Fed is feeling about its sense of security around balance and growth in the U.S. economy. All right. Finally, let's return to talk about Alberta's economy and how Alberta has lost some balance. Now, I know that polar bears are not indigenous to this part of the country. We don't have polar bears here, but I couldn't help but use this picture of this cute little polar bear who has slipped, apparently he slipped and fallen on some ice. Now, there are a lot of photos online, by the way, of people slipping and falling on ice, and they're just hilarious. But I thought, it's not really very nice to use a picture of a human being falling. Let's assume that this polar bear lives to see another day, but this polar bear has slipped on the ice. So we're going to let him represent Alberta in 2015, because I think this is somehow a little bit how Albertans feel about our economy right now. It's almost like we've slipped on ice and very suddenly have gone from the fastest growing province in Canada to one likely in recession, and certainly at the bottom end of the heap in very short order. We've slipped and fallen flat on our back. Well, how did this happen? How did Alberta's economy go from that? Well, you guys are an educated crowd. You know it's all about this. This is really the only story that has driven Alberta's economy into recession over the last 12 to 16 months, the drop in oil prices. I'm not going to spend a lot of time this afternoon talking about how oil prices fell this low, we really know it is OPEC. It's a supply side story. It is also a demand side story too, and that's where I come back to China, especially in the summer of 2015. Where is the demand going to come from? But nonetheless, we find ourselves in this environment now going into the fourth quarter of the year with oil prices at a very discouragingly low price for producers in this province, and a price where there is still a lot of volatility, as Glen was referring to, not a lot of direction, not really a lot of agreement among people where these oil prices are going to end up. Well, this has left us in a situation, of course, in Alberta where we have lost some balance. It's a little bit like Wile E. Coyote. Remember back, when those oil prices were hovering at $60 in June, and they felt like they could stay there for a little while, and then all of a sudden, just like the coyote, the bottom fell out, and we did see oil prices fall over the summertime. Well, let's talk about balance in Alberta's economy. How did we come so badly out of balance when in fact it appeared we were in balance for so long? Between 2010 and 2014, this province had a string of exceptionally strong years of economic growth, averaging 4% real GDP growth in all 5 of those years. There's no other Canadian province or U.S. state or country in the developed world that has put together that impressive stretch of growth between 2010 and 2014. And it felt like there was real balance in this economy, when in fact there were serious imbalances that were growing and growing and growing, sort of quietly under the scenes, and now we find ourselves out of balance. The main imbalance that was growing over that period of time has to do with this. It has to do with salaries, wages, bonuses, compensation, overtime hours, all of the things that have driven wages, increasing wages over the last 10 years, and over the last 5 years particularly. Now, from my presentation style, I don't like to use a lot of numbers. I tend to use more pictures of polar bears and donkeys, but I am going to share a couple of numbers with you in the next couple of slides, because in this situation, I think the numbers really illustrate well the situation that we find ourselves here in Alberta and how we might need to find things come back into better balance. I looked at average weekly earnings over the last 10 years, and for Canadians, so this is all provinces, all regions and sectors of the country, average weekly earnings increased 29% from May 2005 to May 2015. 29% increase in average weekly earnings. Now that is an average number, so some are going to be below, certainly some will be above. It did outpace inflation, general CPI inflation a little bit, so overall not too bad of a number. But in Alberta, average weekly earnings increased 48%. So you can see very quickly here, you don't need to be a Nobel Prize winner in economics to figure out the problem facing this province, is that wages and compensation have increased at such a dramatically faster rate than they have elsewhere in the country. Now, some people might be doing the calculation thinking, 48%, my wages haven't gone up by 48%. In fact, a few weeks ago, kind of a funny story, I was giving this presentation to the Alberta Teachers Association, and when this slide went up, they all bust out laughing. Our wages have not gone up 48%. And of course, that number, it is an average number, meaning that many in Alberta have seen little or no wage increase at all. But that also means that at least half the people have seen wage increases in far excess of 48%. Where are some of those? Well, in Alberta's oil and gas sector, average weekly earnings have gone up 56%, compared to the 29% for everybody else. Now, I really don't put this slide up here to, shame or embarrass anybody who works in the oil and gas sector, but the reality is that cost containment has been very difficult in the petroleum sector, in this province particularly. Now, that isn't anybody's fault, necessarily. Companies felt like, well, to get projects going, to get people out there on the rigs, to find and attract the talent we need, we have to pay compensation to attract them. But it has resulted in this escalation of costs for the energy sector. Now, it is going to vary by company, absolutely. Probably a lot of you that work for oil companies are going to be doing the calculation in your head right now. But I'm told that on average for the industry, about 70% of expense is labor costs. And when they're increasing at this rate, you can see the dramatic cost disadvantage suddenly the sector finds itself in. So in 2015, if there is some good news, what we are seeing now is a rebalancing of the economy. And this has been a little bit long overdue, but we are now seeing a rebalancing in terms of wages and compensation and overtime. Companies are scrambling to get their costs down. That's the good news. The bad news is companies are getting their costs down. And that, unfortunately, does land on the backs of individuals and households in the form of their paychecks. We are seeing layoffs in this city, particularly among very high-paid, high-skilled jobs in oil and gas, in the professions, the professional, scientific, and technical occupations. That's where Alberta and this city has seen the most dramatic decrease in employment. And also, as Glen was alluding to, there have been some job increases at the same time, and that is absolutely true. In fact, year over year, Alberta's employment, total number of people working, is higher by about 40,000 people than it was last year. Employment has increased 1.4%. So how does this happen in a downturn year? How can we be adding jobs? Well, what is happening is a lot of non-energy sectors, companies are picking up employees that were laid off in the energy patch, but they're hiring them at jobs that pay far less. One of the sectors that is doing that, the transportation and warehouse sector, which about 18 months ago, if you would have asked any one of them, a trucking company, a warehouse company in this city, if you would have asked their biggest problem, it would have been attracting and finding workers. Well, in September of 2015, they are seeing some really nice resumes coming through the door, and they're not having to back up the money truck to get them. They are now competitive with an energy sector that, again, a year and a half ago, they were not competitive with wages in those sectors. So not only are we seeing some layoffs, we are seeing some rehiring in new sectors or different sectors, new jobs, but the compensation is lower. That is helping rebalance wages and compensation in the province and in the city. So, just to conclude, when will we see some, by the way, this is not my dog. I have two dogs. Neither of them could do this. They would look really quite puzzled if I started laying dog treats on their nose, but when will we see, or what are the factors that we'll have to see fall into place before Alberta's economy and Calgary's economy will regain some balance? Regaining balance. The first is we are going to have to see some rebound in oil prices. Now, sadly, this is the one thing over which we have no control at all. We all know that world price is set outside of, we are a price taker for those oil prices. So there's nothing we can do about it, but I do think we are going to have to see some increase in price, that WTI benchmark price. The number I'm looking for is $60, which coincidentally was Glen's forecast price for next year, ending 2016 at $60. Again, it's going to vary by company. Some companies are not going to be profitable at $60, many will, but I think $60 will be a number that will at least stabilize the industry in this province. It's not a great number, but I don't think oil prices are going back to 107 anytime soon. In fact, it might be a bit of a struggle getting them back to $60, but I think 60 is the number and some stability at 60. $60 WTI is the number that I'm waiting to see before I can start to say, all right, the first factor has come into place in stabilizing Alberta's economy. The second is we are going to have to see a rebalancing of wages, bonuses, and salaries and other costs, not only in the petroleum industry, but in Alberta's overall industries. That cost containment, rebalancing and getting costs down, especially on the labor side, that is already happening. That's been underway for a year already. I think we are going to see more of it in the coming months. Again, that is the good news, is that this rebalancing is taking place even as we speak. Another factor that has to fall into place, we're going to have to see strong performance in the non-energy sectors. And here I'm looking at agriculture, forestry, and tourism particularly, the second, third, and fourth largest industries in the province. 2015 was actually a pretty good year for forestry and for tourism. They were both helped out by that low Canadian dollar. The forestry industry, as I was saying, they're another industry that really benefits from a lot of resumes coming through the door. Forest producers are no fan of oil at $107 a barrel. But forestry, they had a good year. Prices were decent, helped out by that resurging U.S. housing market. Agriculture was a bit uneven in 2015. Depending on which part of the province in which you were living, a drought really hit a lot of parts of central Alberta this year. and leaving yield not fantastic. It wasn't a catastrophe year, but drought did prevent a lot of that yield from sort of developing. Prices are only okay. Cattle prices are through the roof. So the cattle ranchers, they should have really had a great year in 2015. But anytime I talk to cattle ranchers about how great prices are, they always pull me aside and say, yeah, but feed costs are crushing me. So it is true that those higher feed costs and drier pasture land in 2015 really did chew into the profits of a lot of those ranchers this year. So agriculture in 2015 was only kind of mediocre. The other two were stronger. 2016, we are assuming that will be a better year for agriculture. We can assume average crop yields and decent prices still, especially in the livestock side. Forestry and tourism, I think, will also do well. So that piece will have to fall into place. And then finally, we will have to see the Canadian dollar remain at where it's at or possibly even lower. Now, I don't want to be misinterpreted as cheering on a lower Canadian dollar, because if the Canadian dollar falls, all of us, most of us in the room, we hold our assets predominantly in Canadian dollars, especially real estate. If the Canadian dollar falls, we are less well off. We have to recognize that. But the Canadian dollar, where it's at, has been a tremendous cushion to not only the Canadian economy, but Alberta's economy as well. Now, fortunately, of the four factors, I think we're almost most certain about this one. I don't think that Canadian dollar is going to go anywhere dramatically higher anytime soon. And that, I think, will be one of the proper things that we I guess, can anticipate in 2016 in helping stabilize Alberta's economy and bring back balance. So those are the four factors. Finally, when can we expect all of that to happen? Well, I am now anticipating a modest recession in 2015. We will be releasing our fourth quarter economic forecast for Alberta's economy on October 1st. We're just in the process right now of putting together the final numbers, so I can't really say exactly what our forecast is going to be, but we are expecting now roughly an order of magnitude of a 1% drop in Alberta's economy. Exactly, I think, what the conference board had. And yes, Adam, you were exactly right back in June. It is going to be about that 1%. The good news on that, and just a little bit of perspective. So if we have a 1% contraction, well, as I said earlier, we've just come off of 5 years of extraordinary growth. 5 years cumulatively, the real economy in Alberta has increased 20%. So it was 20 steps forward and 1 step backward in 2015. It is going to be a difficult year. It is going to be a modest recession, but I think some perspective is always helpful. We are going to experience a higher unemployment rate in Alberta. I do expect some pickup in layoffs to take place between now and Christmas time. I think a lot of those energy companies who were sort of locked in with hedging programs on oil prices, a lot of those hedges are expiring. I think cash flow is going to become critically low, and we are going to see more layoffs between now and Christmas. 6% unemployment, that's where we were sitting in August. That is still not bad. That's not too far off a balanced labor market that I would say 5% would be sort of a balanced market. 6% not too far off. But I do think we will crest above 7% by early 2016 before we see that stabilizing, that rebalancing, and gradually it will come down. So 7%, maybe even 7.5%. 7.5%, by the way, is the highest number in which we crested in 2009. So this is not a number that is, uncommon in Alberta. It's not a great number. It's too high. But we do go through these cycles, and I think over the next several months we will see that unemployment rate elevate. I think we will see below average growth in 2016, and when I say below average, I'm talking about 4 Canadian provinces. Again, I don't have a pinpoint forecast, but I see modest growth coming back in 2016, only because those 4 factors that I listed above, those 4 bullet points, I do see them coming into place sometime in 2016, probably in the latter half of 2016, especially on oil prices. And then getting back to something closer to normal rates of growth in 2017 or maybe 2018. So unlike the downturn of 2009, which was a very sharp downturn but a very short one, I think the downturn of 2015, 2016 will be shallower, but it will probably linger on a little bit longer than we would like. So with that, I will conclude, and I look very forward to your questions and comments afterwards. Thank you very much.
I'm coming.
Thank you very much, Todd. That was great. Glen, have a seat as well, and we have the opportunity now to put some questions to you, and we did get some questions in through Twitter, so thank you very much for that. Let's start with Glen. We hear a lot of talk about diversification and the need to diversify an economy. To what extent would diversification truly impact the future boom-bust cycles in Alberta?
Well, I guess my answer is diversification is great in theory. It's really hard to do in practice because it really requires a whole array of government policies, different decisions by business over time. Alberta is very dependent upon hydrocarbon resources. I like Mary's points earlier about looking for diversification across the value chain. And to pick up on something you said, Todd, make yourself less of a price taker and more of a price maker. You can do that in the oil patch as well. You can become expert at management services, at financing, at marketing, giving strategic advice, at developing new technologies. So that's one of the ways to diversify. I guess the other, though, is that I think it's probably time to have a really grown-up conversation in Alberta about fiscal diversification. Get less dependent upon royalties and more dependent upon in-province resources to fund your healthcare system, education, and infrastructure. Because if you don't, you're going to ride that curve again, and it's very painful. And I know that people don't want to talk about things like sales taxes, so maybe you don't go there. But I guarantee you're going to have to find other in-province revenues to have a more stable fiscal position going forward.
Todd, Alberta has seen recessions many times before. As you say, the last one just in 2009. What do you think it is that makes this one different?
Well, this one will be different in many respects to a lot of other recessions we've had. There's similarities, but the big difference between this recession and the most recent one, for example, the 2008-2009 recession, that was a recession that hammered every sector. I mean, it was a global credit market seizure. No one could get access to cash. Every commodity was low. We thought this was the end of capitalism back around March of 2009. Everyone was panicking, and I think it's true to say there really was a sense of panic in Alberta at the time. 2015, I'm not picking up panic. I'm picking up some anxiety and some gloom, but this downturn is really concentrated on the petroleum sector. Yes, that does have a lot of ripple effects across a lot of other industries, but there are other industries that are doing well. I think maybe to get back to the previous question, 2015, 2016 could really be an anchor year, a couple of anchor years, in which other industries could gain a toehold in the province and help diversify the economy, because this downturn is focused on the petroleum sector. Other sectors are actually still doing pretty good.
Like what? What sectors would this be a great opportunity for them?
Well, one of them would be manufacturing, especially manufacturing away from the traditional energy sector. 80% roughly of Alberta's manufacturing at the moment is either an input or an output from the petroleum sector. It's either steel pipe or it's refined petroleum. 20% is things like food products, wood products, some high tech, but I think there's room in that 20%, maybe especially around some value added in the forestry sector, in agri-food and agribusiness. Those sectors, I think, could do really well. And also the high-tech sector, which right now in Alberta, high-tech, I describe it as 1,000 pinpoints of light. It doesn't really have a core or a concentration that you can point to. It doesn't have a Waterloo, Ontario, and it's not like the energy that has Calgary, but it's 1,000 pinpoints of light, a lot of them doing quite well. And I think 2015, 2016, with the lower Canadian dollar, it could give a lot of those manufacturers an opportunity to really thrive.
This has been, of course, Glen, a very tough year in Alberta, but in your experience, to what extent is the rest of the country feeling or not feeling what we are?
Well, actually, our forecast was actually raised a little bit for almost every other province because they're consumers of energy. When you see your price of gasoline going from 130 to 95 cents, as has happened in Ontario, that gives you a nice chunk, probably $500 a family, that you can either save, pay down debt, or spend on other things. So in fact, the oil price itself is a two-edged sword. It plays very differently for consumers. And of course, the recovery of the U.S. combined with the dollar, as Todd said, with the dollar hopefully hovering around 75 cents, that's made us a lot more competitive. So you're seeing kind of a mild recovery right now in central Canada and BC. BC is arguably the leader right now in terms of growth, and that's really being pulled along by the U.S. housing recovery. So for the rest of the country, this is very much in Alberta, in Newfoundland, a little bit Saskatchewan issue, but for the other provinces, they're actually having better years quite often than they were expecting.
Todd, this is one of our Twitter questions today. Apple, you might not have seen this, has announced electric car production, so they're hoping for it for 2019. Such a ubiquitous product in all of our lives. So to what extent do you think that shift toward more electric vehicles might then affect the oil demand curve?
Well, that's a great question, and I think it's one Albertans, I don't think we need to be afraid of this question. I think we need to realize the world is moving in a direction where they're demanding less and less, fewer hydrocarbons all the time. I think there could be lots of opportunity for Alberta in that by adding to our energy portfolio, as well as hydrocarbons, but adding alternative sources of energy generation, and especially the engineering around how to create that energy generation. So in this case, electricity. While these cars have to be powered by something, where is electricity going to come from? The whole world is trying to get off of coal. The whole world is trying to get off of nuclear. Where are these new sources coming from? Alberta could be a world leader in perhaps deep earth geothermal power generation, which is something that I've talked about a little bit before. An industry that is kind of in its infancy when we're talking about digging really deep into the earth crust to get to heat. Alberta is really well situated for this because the geology is all wrong in Alberta. And I always say if you can make the technology work in Alberta, then it's a cinch to sell that technology to the Chinese and the Germans and everybody else who are going to be wanting to plug in their electric cars into something.
Gentlemen, thank you both so much for your time today. Lunch is served. Please enjoy your lunch, and we'll resume again in about 40 minutes' time with the Governor of the Bank of Canada. I hope you all had a chance to enjoy your lunch. If you're still eating, please, of course, continue to have your meal. I'd like to remind you, too, that you are able to submit your questions to the Governor of the Bank of Canada to communications@bankofcanada.ca. So please feel free to email us any questions that you might have as you hear the Governor speak, and we'd love to address them. Ladies and gentlemen, please join me in welcoming Mayor Naheed to stage.
Well, thanks very much, Tara, and thank you all for spending some time with us this afternoon. I want to say a special welcome to my colleagues on Calgary City Council, all of whom I think are here today. We are actually in the middle of a City Council meeting, so I discovered how to get them all to this event, which is we didn't have lunch at the City Council meeting, and I told them lunch was here. But the real reason, of course, we're all here is, as a matter of fact, we are in a meeting today discussing the city's response to the economic conditions that we're facing right now. So it's actually absolutely perfect that we have an opportunity to hear from these three great economists today. You heard from my colleague Mary Moran already about Calgary Economic Development's economic strategy for Calgary, building on our energy. It's a collaborative plan, 10-year plan that's really setting our city up for sustainable economic growth. And that really is not, when I use that word sustainable, I don't mean just environmentally sustainable. I mean financially, socially, and environmentally sustainable. Perhaps another good word we could use is resilient. A city that can take what comes and manage to continue to do great work. And it's all about aligning the city, our civic partners, the private sector, community organizations to achieve economic competitiveness, to embrace shared prosperity, and to build a strong community. And that means we have to be thoughtful together as a community over what it is we are building here. And you heard a lot of that already this afternoon. You know, Mary Moran loves to use the term purposeful diversification. But I think it goes a little bit more deep than that. I think what we're really talking about is this question of resilience. How do we build a community that does well in good times and bad? How do we build a community that can respond to economic change, not necessarily with business as usual? How do we build an economy that leverages our strengths, that lifts people out of poverty, that supports and grows creativity and innovation, that creates jobs for young people, that presents opportunities for small business, that provides a decent place to live for all of our citizens? You know, I was in this building, in the room next door, on Thursday evening. I was sitting in the front row listening to the three of the people who would like to be Prime Minister talking about the economy. I was also live tweeting from the front row, which I realized later was exceptionally rude because all they saw was my shiny bald spot the entire evening, until my battery died. But what I really, really appreciated about that debate, and I can tell you my political analysis of what happened at the debate later if you like, but I'll tell you what I really appreciated about that debate, which is in a debate about the economy, we weren't talking just about taxes and job strategy. It was very, very clear, and the Globe and Mail deserves some credit for this, that a debate about the economy is not a debate about the economy unless it's a debate about infrastructure, about immigration, and above all, about housing. When we talk about housing in particular and the crisis we're facing in housing across this whole country, we realize that discussions of housing are not discussions of social programs. They are discussions of economic programs. Even in this economic downturn, we still have restaurants in Canmore that have to curtail their hours because they can't hire staff, and the reason they can't hire staff is because those people don't have decent places to live. I constantly hear from people who are trying to set up businesses here still, even in these economic times, that their biggest challenge is hiring people, and their biggest challenge in hiring people is folks don't want to move to Calgary because it's very expensive to live here. So we have to get our heads around understanding that all of these issues are tied together. And that's why the economic strategy, being a broad-ranging and holistic strategy, is so important for us. I'm going to go off script. Those of you who know me might be shocked that I'm going off script. You're probably more shocked that there is a script. Mary Moran, our new CEO, she makes sure that I am tightly controlled in everything that I say. How's that going for you, Mary? I want to mention two quick things. Number one is about infrastructure. What I thought was really interesting about that federal government debate the other day was that when the candidates were asked about infrastructure, they all agreed that investing in infrastructure at this time is the right thing to do. We no longer have to make that argument. We no longer have to make the argument that investing in reducing congestion and cutting people's commutes is directly an investment in the economy. A study by the C.D. Howe Institute showed that congestion costs the Greater Toronto Area $11 billion a year in lost productivity. That's greater than the annual turnover of Canadian Tire. And investing in cutting congestion, which means investing in public transit, is a solid economic investment as well as a social one. They all seem to understand that. I have to say they didn't understand the housing so well. They all seemed a bit surprised to be asked a question about housing. But hopefully we will continue to have that debate over the next 30 days and continue to make sure that every single person in the country has a decent place to live. And as we were discussing at my council this morning, in a world where construction prices are incredibly low because we're not competing with giant mega projects in northern Alberta. In fact, our last two projects that we put out to tender have come in more than 20% lower than they came in last year. And at a time when interest rates are unbelievably low, I won't say money is almost free because the Governor of the Bank of Canada might not like that, it makes a ton of sense for us to be investing in infrastructure now. And that is something that I will continue to advocate for, building stuff that we need to build anyway to improve people's quality of lives, but to do it at this time. Second thing I'm going to say is I was also very pleased to hear the conversation about immigration as part of our economic discussion. But I also want to highlight that that particular conversation is a conversation we have to have nationally that needs to go beyond the conversation about the economy. It's a conversation that cuts deep to our values about who we are as Canadians, about our values of what it is we do in the world. This weekend I was reminded of the inscription on the bottom of the Statue of Liberty written by a Sephardic Jew who had escaped the pogroms of Eastern Europe. You all know it. Bring me your tired, your poor, your huddled masses yearning to breathe free. And if we develop an immigration strategy that says we don't want the tired or the poor, that those huddled masses can huddle somewhere else, thank you very much, then we are losing out on an important part of who we are as Canadians. And that's why, for me, having this conversation and managed to speak in front of 1,500 of my neighbors and talking about our responsibility to the world, our responsibility to the refugees, not just from Syria, but from everywhere in the world, is an incredibly important part of what we do and an incredibly important part of who we are. And I look forward to all of your support as we roll out our strategies to ensure that Calgary remains a place of sanctuary, a place of welcoming, a place where everyone has the chance, right here, right now, to live a great Canadian life. As you know, I'm the mayor, and my job as mayor is to be endlessly optimistic. And I am endlessly optimistic. I'm endlessly optimistic about many, many things. I'm even endlessly optimistic about the fact that my council meeting might end before supper today. Maybe. I'm optimistic about where we are, about what we're turning around in the economy here, about our future. I want to tell you one specific thing I'm optimistic about. I'm very optimistic about the future of Calgary economic development. This is the first time that I've had the opportunity to stand in front of a big group and say, I am thrilled about our new CEO. You've heard from her already, but I am absolutely beside myself happy that Mary Moran has accepted this challenge for us. She's done incredible work for CED in her past. She's the one who developed our 10-year economic strategy update. She developed the award-winning flood recovery campaign, YYC is Open, and of course the magnificent Be Part of the Energy campaign that has been so much about us. And I know she is going to be outstanding, because the most important thing about Mary is not the fact that she's unbelievably good at her job. It's not the fact that she is conspicuously fit, according to the Globe and Mail. You knew I was going to, Mary. I don't know what that means. Am I conspicuously fit? No. Inconspicuously fit, maybe. But the most important thing about Mary, and the reason I'm so excited to have her in this role, is she loves this place. She is unbelievably passionate about Calgary, about the future of Calgary. I think I can only think of one person who is as excited about the future of the city as she is, and I think we're going to work together pretty well on that. And we know she is going to do an outstanding job. So Mary, thank you for taking on this role. Thank you for public service. Thank you for being here. It always shocks me to remember that you are not actually here to listen to me. And in fact, I am absolutely thrilled on behalf of the citizens of Calgary that Governor Stephen Poloz is here with us today to talk to us a little bit about the economic outlook. Who better to have here? I think this is the first major public engagement we've had with the governor, and so I am absolutely honored that he is spending time with us today. I'm not going to go through his entire bio. As you know, he's been the governor of the Bank of Canada since 2013. Prior to that, he had an extraordinary career in the public and in the private sector as an economist, as a senior manager, and as a leader, and it is wonderful that he is here with us today. So I'm going to leave. I'm going to shut up. Here is Stephen Poloz.
Thank you. Well, good afternoon, everybody, and thank you very much, Mr. Mayor, for that warm Albertan welcome. I never need much persuading to come here for a visit. I've been here several times in the past year, including just over a week ago, in fact. But this is my first public speech here in Calgary as governor. So I want to thank you all, and I mean all, very much for being here today. Now, this isn't the first time that a governor of the Bank of Canada has come to Calgary to talk about commodities. And I suspect it won't be the last. I mean, it's an obvious discussion topic here in Alberta, where resources make up more than a quarter of the economy. Of course, such riches aren't unique to Alberta. Natural resources have been a big economic story for this entire country since the time of European contact. Now, today, Canada is the only major exporter of natural resources among the G7 nations. Oil is just one part of the story. We're also a major producer and exporter of coal, natural gas, base and precious metals, minerals, such as potash, for example, agricultural and forest products. Because Canada has been endowed with such a wide variety of resources, we've had to learn how to deal with large swings in their prices. Now, I don't just mean the usual high degree of volatility, which is common among many raw materials. I'm referring to the long-term swings in prices that are often called super cycles. Now, what's important to remember is that these long-term swings are driven by, first, fundamental economic laws of supply and demand, and second, by the continuous technological progress that can affect both supply and demand. Now, the pattern of a supercycle is very familiar. A large and persistent increase in demand leads to a sustained upward pressure on resource prices over a period of years, and those higher prices act as an incentive to boost supply. So companies act by, for example, investing in new capacity, finding methods to increase their efficiency. And while high prices can certainly spur research and development, technological progress has been a constant theme in natural resource industries. Such advances uncover ways to raise output and lower production costs. And it's because of this continual progress that inflation-adjusted commodity prices have generally been trending lower for some 200 years. Now, the investments that lead to increased supply, of course, can take years, sometimes decades, to compete. But over time, the higher output that is generated by those investments combines with stabilizing demand to bring about a period of downward pressure on prices. And faced with those lower prices, companies then may scale back investment and production. Now, ultimately, those lower prices will encourage more demand, and the reduced investment will crimp future supply, and that combination leads, again, to higher prices. And producers will ride the price cycle all over again. Now, any economy that relies on natural resources is naturally going to be challenged by large movements in their prices. Now, these shocks are more than just swings in Canada's national income. They also force businesses to make decisions about the way resources, such as their capital and labor, are allocated. These decisions often lead to difficult adjustments, but they're necessary for maximizing our economy's potential. Now, it's true that an abundance of raw materials may complicate the management of companies and complicate the conduct of economic policy. But I can tell you that it's far better for a country to have resources than not to have them. And even when prices are falling, as they have been recently, our endowment represents a store of value and a source of future riches. So what I'll do in the rest of my time today is to talk about some of the global forces that have been driving recent swings in commodity prices and look at how they may evolve in the years to come. And then, just to emphasize how uncertain the outlook can be, I'll talk about some alternative scenarios that could dramatically alter the future for producers. And finally, I'll revisit some of the lessons that policymakers like me and business leaders like you can apply today and in the future. So let's just take a look back at resource prices over the last 15 years or so. Now, we saw a large and persistent increase in demand sparked by rapid economic growth in emerging markets. In China, for example, the world's most populous country, economic growth averaged about 10% per year between 2001 and 2011, a period that included the global financial crisis. Now, Chinese growth has meant enormous demand and rising prices for many of Canada's resources, especially for coal and oil, as well as base metals such as copper and nickel and aluminum. Now, as millions of people in emerging markets have been leaving rural areas for cities, demand has increased for building materials such as the iron ore used in steel, and this has supported prices. Now, we all know that the financial crisis led to price declines. Many raw materials rebounded quite sharply afterwards, and by April 2011, commodity prices had reached their post-crisis peak once again. The thing is, though, that rapid economic growth tends to moderate as a country's expansion matures. Chinese economic growth has eased to an average of about 7.5% since 2012, as the authorities have tried to engineer a more sustainable and domestically oriented expansion. In a similar way, India, which saw annual GDP growth near 9% from 2005 to 2010, has also moderated since 2012. Now, while it's true that these cooling growth rates have had an impact on commodity prices, we shouldn't forget that emerging markets remain an important source of demand. Indeed, since the start of this decade, the Chinese economy, now the world's second largest, has more than doubled in size when measured in current dollars. Now, on the supply side of the market, we've also seen responses that are putting downward pressure on prices for metals and some energy goods. So, for instance, global iron ore supply continues to expand today, despite lower prices. But this is thanks to the impact of multi-year investments that were made when prices were high. And these investments led to expanded capacity in low-cost areas, such as Australia and Brazil. But let's talk about oil prices. Now, this topic is obviously of great importance here in Alberta because of its impact on employment and, of course, the overall economy. But it's also important for Canada as a whole, given the implications for national income and interprovincial trade, as well as the industry's sizable influence on our total business investment. So why have oil prices fallen so much? Well, for me, the main reason is that supply rose sharply. And this is thanks primarily to technological advances in oil extraction pretty well everywhere. This includes our own oil sands, tight oil, and the Bakken deposits. You consider in particular the technological progress that enabled producers to tap tight oil reserves. Output of this oil from the US alone, which essentially didn't exist before 2008, has now reached 4.2 million barrels a day. Now, that increase in US output over that period is roughly equal to all the oil that Canada produces in a year. Now, given the dramatic drop in prices over the past year, of course, the bank has spent a lot of time speaking with business leaders, mainly through our people right here in our Calgary office, to try to gauge precisely how producers are going to react. I can tell you, at the start of this year, oil companies were saying that they intended to cut investment this year by about 30%. Prices didn't recover as much as they were forecasting at the time, though. So by mid-year, companies were telling us that they would cut their investment intentions by about 40% this year. Currently, based on discussions that I've had personally over the last couple of weeks, many firms are still revising their longer-term expectations for oil prices. So obviously the bank will continue to assess what the impact may be on their investment spending and therefore on Canada's total investment spending going forward. But what this all means for the evolution of oil prices is very hard to say. The bank's usual practice is to assume for our projection that oil prices will remain stable at their recent levels, and then we use our economic models to test alternative scenarios for the future. And I know that many companies will do exactly the same thing. but that method can be a little risky. Because the vast majority of oil transactions are financial rather than between producers and users, those prices that we see every day tend to be much more volatile than the underlying fundamentals of supply and demand. But before I move on, let me emphasize a point. Lower prices for base metals and oil today do not mean that long-term investments, which may take years to complete and last for decades, were somehow a mistake. Without those investments, we would never have been able to capitalize on the higher prices, which boosted Canada's aggregate income. And what matters for a given investment is how prices evolve over the entire life of the project. And that's impossible to know when long-term investment decisions must be made. Just to illustrate, from the end of 2008 to the end of 2010, just 2 years, the price of copper tripled. Oil and nickel prices more than doubled in that time. So if you believe in market forces, as I do, these movements represented a clear signal for companies to invest and expand output. And those who were able to recognize the opportunity, make adjustments, and exploit the higher prices were rewarded. And the increased income brought important benefits to Canada's entire economy. Now let me spend some time talking about the future. The price cycle that I've sketched out might appear to be fairly predictable. But history has repeatedly shown that new technologies can quickly upend assumptions about future demand and supply for almost any resource. So for example, back in the 1970s, there were predictions that the world would run out of copper by the end of the century. The people who made that forecast did not foresee that copper wire, which was long a staple of communications infrastructure, would be replaced by fiber optic cable with its glass threads made from silica. Now this technology helped reduce the demand for copper, in essence extending its supply for a very long time. In a similar way, digital photography has had a dramatic impact on photo processing. Now 20 years ago, just imagine the idea that everybody would carry around telephones that were also good quality cameras. That was ridiculous. People took pictures with cameras that were loaded with film, and they took the film to a developer. The processing of the film consumed a lot of silver. And back then, if you didn't anticipate the emergence of digital photography, you might have expected this source of demand would continue indefinitely. Indeed, the use of silver in photography peaked in 1999 and has fallen by almost 80%, 80% since then. So it's these sorts of technological advances that make predictions about future demand or supply extremely difficult. But it's also these technological advances, combined with Canada's many gifts of natural resources, that will generate the opportunities to secure our future prosperity. Our goods will remain in demand. We will continue to have lumber for houses, metals for industrial production, oil for use in plastics, and let's face it, it's hard to imagine that Canadian roads won't continue to need to be patched up with new asphalt. But further, it's important to remember that Canada's endowment is extremely diverse. While the cycles for base metals and oil have turned lower, there's still substantial demand that's supporting the prices of many agricultural goods, for example. As I noted, with continued growth in emerging markets, their populations are becoming increasingly urbanized. Here in North America, over 80%, 82% of the population lives in urban areas. Now that compares with only 55% in China and just 30% in other emerging markets such as India. Now this trend toward urbanization is likely to continue. And with it will come growing demand for all the goods linked to household consumption, and especially agricultural products. You consider the hundreds of millions of people who are climbing the income scale in India and in China, and their changing diet implies much more than just stronger demand for traditional protein sources. It also implies demand for inputs that we have, such as fertilizers, animal feed, fish feed, oil seeds, specialty crops such as lentils and chickpeas. And as I saw, the latest traffic figures from Port Metro Vancouver show sharp growth in shipments of wheat, specialty crops, solid gains in meat, poultry, and potash out into Asia. Now, Canada is particularly well placed to tap growing demand for fish and other seafood. Now, Canadian seafood exports to China in the first half of this year grew by 11% compared with the same period last year. To take one example, 60,000 lobsters are flown from Halifax to Shanghai every week. Now, this business has been aided by advances in technology, whether it's in shipping or in production. And thanks in part to this demand, lobster prices have been rising sharply. But in terms of aquaculture, however, there appears to be considerable more growth potential. Mussel farming grew by about 35% over the last 5 years or so. Farmed salmon production has more or less plateaued around 100,000 tons a year. But Canada has more coastline than any other country in the world. Yet the volume of our farmed seafood output is dwarfed by countries such as Norway, which produces 7 times as much as Canada does. Now, I'll leave it to others to figure out how best to tap this potential resource. But there are others. Just to mention others, rare earth minerals, the 17 elements used in high-tech products such as cell phones and hybrid vehicles, these represent another potential source of new growth for Canadians over time. Now, it's impossible to know with certainty where opportunities will emerge 30 years from now. What new technological advances lie just over the horizon? Consider, for example, the future of water desalination. Right now, the process of removing salt from seawater is too energy intensive to be economically feasible on a large scale. But you don't know. Perhaps we're just one technological breakthrough away from solving this problem. You can imagine the impact if the chronic droughts plaguing Western North America and Australia could be eased by simply desalinating ocean water. Well, the point of this narrative is not to educate you on all these possibilities, but to emphasize just how uncertain the future is. Businesses, consumers, governments, policymakers, we must all plan for the future based on the best information we have. And at the same time, natural uncertainty requires us to be flexible, to adapt to circumstances that can change rapidly. In concrete terms, this means business leaders must be aware of the risks involved in resource production, manage those risks as best they can, and be ready to react to market signals and seize opportunities. Now, history has shown that the companies that are nimble are the ones that are best poised to thrive over time. And policymakers can help. Policymakers can help in these efforts by encouraging economic flexibility. This means allowing the necessary adjustments to take place. It means not frustrating flows of investment or flows of labor from one region to another. Canada's labor market showed impressive flexibility when oil prices were rising, as workers flocked to Alberta to fill demand. And in our latest Business Outlook survey, the bank saw evidence of labor shortages beginning to ease in regions where some interprovincial workers are returning from the oil patch. But before I conclude, let me say a few words about how monetary policy fits into this picture. There are lessons that we can take from previous price cycles. Now, the most important of these is the value of our monetary policy framework. And we can't do much about resource price shocks, but our policy can help the economy adjust to them Now, in particular, our floating exchange rate helps absorb some of the impact of these price movements, and it sends signals that facilitate future adjustments. Now, you think back to the previous decade, from 2002 to 2012, oil prices rose from about $25 per barrel to more than $100 a barrel. And that led to a big jump in our national income. But over that same period, the Canadian dollar appreciated from a record low of around 62 cents to above parity with the US dollar. And what that did was to help reduce the inflationary risks that came with the stronger growth and the increased income. Now, similarly, over the past year, both oil prices and the Canadian dollar have fallen sharply. The floating currency, again, is helping to reduce the disinflationary risks that have come with that cut in our national income. Further, allowing the currency to float frees up the Bank of Canada to concentrate our single policy tool on our single target, which is inflation. And if we tried to offset these currency movements, we would end up frustrating the natural shifts in economic resources. Now, by focusing on our mandate to keep inflation low and stable and predictable, the bank has built up credibility. So Canadians have well-anchored inflation expectations, even in the face of large price swings. For example, when we've seen big moves in energy costs, such as the price of gasoline, there's been little evidence that consumers adjusted their overall inflation expectations, either upward or downward. Well, why is that important? Well, since Canadians see our commitment to our target as credible, that makes it much easier for us to reach our mandated goal without needing big swings in output or interest rates. So those of you who are as old as I am can recall our experience with the oil price shock of the 1970s. And you remember the subsequent effort that was required to bring inflation under control. At that time, without a credible target and with unanchored inflation expectations, inflation soared. Extremely high interest rates were needed to get price increases back under control. Now, another point to remember is that swings in commodity prices can affect the normal relationship between the total inflation rate and what we call our core measure of inflation. For example, total inflation today is being pushed down by the impact of lower energy costs. In contrast, core inflation, which strips out those volatile components, is facing upward pressure because recent declines in the exchange rate are boosting the prices of imported goods. However, we expect all of these to be one-off effects, and as such, we look through them. As we noted in our July monetary policy report, when all the temporary factors are stripped out, the underlying trend in inflation in Canada is in the range of 1.5% to 1.7%, which is a little below our 2% target. Now, given these complications, the bank is looking now at how we measure core inflation. This is part of our regular review of our inflation targeting regime. Next year, we'll answer the question of whether the bank should continue to focus on one preeminent measure of core inflation, and if so, whether our current core measure will remain in that role. In our interest rate announcement earlier this month, the bank noted that the resource sector is continuing to adjust to lower prices, and that these complex adjustments will take considerable time. Our inflation targeting regime will help to facilitate those adjustments. Canada has seen this movie before. We've managed it well in the past, and I'm confident that we'll continue to manage it well in the future. It's time for me to conclude. As Albertans know well, it can be hard to ride the cycles in raw materials prices. The resource price fluctuations affect all countries, whether they're consumers or whether they're producers. Canada is actually very fortunate to be both, and we shouldn't ignore the resources that we have been blessed with. Natural resources bring opportunities. Over the years, Canadians have used our endowment to build a prosperous economy, and we will continue to do so. And rather than resist market forces, Canadians should heed the signals sent by those price movements. We've adjusted to rising prices, we can adjust to falling ones. Now, these adjustments are never easy. They're often difficult, and certainly they're painful for affected individuals and for their families. But they are necessary. For our part, the Bank of Canada will continue to promote low, stable, and predictable inflation, and doing so is the best contribution that we can make to helping promote both strong, steady economic growth and the flexibility needed to ease those adjustments and help our resource-rich country thrive. I thank you very much.
Thank you, Governor Poloz, and thank you to all of you who've been emailing in questions. We have another 10 or 15 minutes with the Governor this afternoon, so we'll pose some of these questions. First of all, how long will it take for the super cycle in oil to turn up?
Oh my goodness. What's the next question? No, seriously, what's the next question? Okay, no, I'll give it a shot. Well, that's, of course, I told you enough to know I don't know the answer to that question. But the point thing is that we know that these low prices are affecting both demand and supply. And so when we ask ourselves, how much of an overhang of supply is there today? It varies, that estimate varies from analyst to analyst, but it's not an unlimited amount. And so we've got demand continuing to grow and arguably is picking up speed because the world actually is picking up speed. And so that plus the lower price is causing demand to grow. And of course there are areas where I suppose supply will be curtailed, at these low prices, certain examples in tight oil plays perhaps in the US. But that combination is the kind of combination which takes a while to happen, but then you reach a new state in which things are more normal. I don't want to hazard a guess of when that would be. It's going to take some time. And I certainly won't mention a number as to where it might settle out. But there's more experts in this room on oil than you can shake a stick at, so I'll leave it to them.
Todd and Glen mentioned this a little bit when they were speaking, the outlook for China. What do you think it is, and could we see growth there that would help oil prices?
Sure, China is actually growing quite well. What's happening in China is that it's gearing down to a more sustainable pace for the longer term, which maturing economies always do. Those of you who are old enough to remember what Japan did, in 1960, Japan was at about 25% of the US standard of living, and 30 years later, they caught up to the United States. That 30-year growth cycle started off really fast and gradually settled down to a slower growth pace. And that's what's happening in China. We're only partway through that. And so this is Mother Nature at work. But the fact is that China is like twice as big as it was 6 or 7 years ago, so it's demanding more of everything. The fact that its growth rate has slowed down a little bit shouldn't be the thing that bothers us so much. The question is, how much more can we continue to sell to them? And furthermore, I don't think they're slowing down nearly the way we think they might be. We get a lot of chatter about how dramatic the slowdown is. It is not very dramatic. It's a natural process. And the urbanization trend continues and is likely to continue to be resource intensive for a very long time. So I'm actually quite optimistic about China and what it means for us.
What do you mean by financial transactions in oil, and how does that affect oil companies?
Oh, okay. So what I'm referring to there is something like 90% of the transactions that take place in the spot futures market for oil are financial. They're people that use the word bet several times a day. And so that's okay because they provide an essential service, which is to put liquidity in the market that give companies the ability to hedge future sales and stuff like that. So it has a very important contribution to how the market works. But the other side of it is that when there is a news item, such as you read a headline that says, oh my gosh, China's slowing down, there's a tendency for there to be excessive volatility, which is much greater than the movements in the underlying fundamentals of supply and demand. That's all I mean by that. So it just means that you can't just take the recent price as the be-all and end-all, and we kind of take an average over several months to forecast it out, and then we say, well, suppose it's $20 higher, or suppose it's lower. We test those things with our models so that we can put a bracket around how monetary policy needs to be prepared for alternative scenarios.
These are all good questions. You guys were listening very
really
closely.
Good questions.
Are you saying that Alberta and Canada are too reliant on commodities, and is there a risk of Dutch disease?
Wow. I don't like that term very much. But really, the question is, are we too reliant? I mean, like I said, you've got to believe it's better to have some of this stuff than not to have that stuff. So when there's an oil price shock, if you're not a producer country, well, it means if it's an upside, that's bad news for your economy. And if it's down, it's good news for your economy. When you produce it, it's the other way around. So no matter where you are, you have to adjust when prices move. And in terms of being excessively dependent, I don't buy that. Like 20% of our economy is the resource economy. That's very important. It's our backbone. It's always been our history. And the rest is in some way dependent on that continuing to perform. But we're a highly diversified economy. And we should be thankful that we've got resources as part of our diversification, whereas lots of other countries don't have that. So I don't fret about it. What it means to me is that what we need to do is understand it. What are the forces that are being thrown up, and how is the economy adjusting to those forces? And some of those adjustments, frankly, they're difficult for people. Ordinary people have to move, or they lose their job, they have to look for another job. We're a bit encouraged, actually, in the past year. The labor market in Canada has become much more vibrant, more dynamic. There are more jobs, so there's more turnover. People voluntarily leaving their job to get another job, which is sort of a trading up process. And so we're encouraged that the labor market is beginning to work much better than it was a year or two ago. So all that to say, we have the ingredients to adjust to this, as we have in the past. And it feels to me like companies are adjusting more quickly this time around than they did, say, in the mid-'80s, for instance, to something which is fairly similar. For one thing, having commuting laborers, and that's helping the adjustment process, and there happens to be job opportunities back home. So all that to say, I reject the premise of the question, but I hope that answer is good enough.
We've got one more question here. I'm sure everyone is hoping that you'll agree with Todd and Glen on this one and answer no, but we'll see what you think. What are the chances that oil will fall to $20 a barrel like Goldman Sachs says?
Oh, I see. Wow. Todd said no? Okay, I agree. I guess, I have to agree with Todd because he's sitting right there. But seriously, I don't want to put a pin in any kind of a forecast like that. But as I said before, to me, you can see the forces that are acting, and they're acting in a way fairly rapidly, which suggests that both demand is growing and supply is likely to contract. And even if it doesn't, it would only take a reasonably short time to work off the overhang of supply. So in that situation, like I said, in our forecast, we find it convenient to just assume that it stays where it is, and then we'll analyze, well, what if it's higher, so that we understand the implications. That's better for us, because our job is not that. Our job is the monetary policy part. We have to be ready for anything. So if you'll forgive me, I won't agree or disagree to any specific number, and I'll leave that to guys like Todd and Glen. Those are the real forecasters.
Governor Poloz, thank you for your time and for your insight today.
It's a pleasure. Thank you very much, folks. Thank you.
Thank you. I'd like to welcome to the podium, please, Wellington Holbrook, Executive Vice President, Business and Agriculture at ATB Financial, for closing remarks today.
Thank you, everyone. And I promise these comments will be short. I brought a stick to hit the economist if we didn't like what, no, I'm just kidding, that's not that at all. You get to wait to find out what that's all about. But hello, I'm Wellington Holbrook, and I'm the Executive Vice President of Business and Agriculture at ATB Financial. And thank you, Governor Poloz. We know that your schedule only permits a handful of public speaking engagements every year, and we are honored in 2015 that we are your kind of people. And the folks in this room are many of the people who helped turn Alberta's economy. And that means they're the kind of people who are used to doing the talking, but you had their attention for sure today. And I could sense they were listening, and that's the best indicator of your authority, this ability to have and maintain a high rate of interest in the room. And I know this because I'm a banker, and I appreciate a high rate of interest. Well, every now and then, or maybe one more time. Haha, okay, just kidding. Good. That seemed so funny before I got up here. Okay. Stephen, thank you for joining us, and thank you, Glen Hodgson from the Conference Board of Canada. Thank you, Todd from ATB Financial. And what we heard from you today was interesting. It was certainly memorable, Glen, for example, that Nike is potentially going to be sponsoring your speech. And it was controversial in the sense that what would be better to see sliding on ice, polar bears or people? That's a great question. It was certainly a little bit Calgary because Todd is still claiming he's an optimist. But it was pretty hard to hear. He's saying things aren't going to get back to normal until 2017. But it was good to hear that Glen says Alberta's economy is going to grow next year. All in all, I think it was worth it. But along with Calgary Economic Development, ATB Financial helped make this day work because there is a sense out there, and I sense it, and you do. We all sense it. We sense that what ran through what the speaker said today and what ran through the conversations at your tables and in the hallways is that things are different these days. And that's the writing on the walls here at BMO Centre, where we are at today, and it's the writing on the walls in the offices and the plants where you're going to go back to today. And we're not just talking about a $100 barrel of oil anymore. That has changed enough, and we all know it. But there are massive social and demographic and political and economic and business and communication and technological changes that are altering who has power, who has perceived power, who has trust, and who doesn't. And I want to make one suggestion, and I really am hoping you will consider this, because I think it's more true than ever and more needful to say than ever, and that's that it's our job, all of us in this room, it's the job of each of us here to not just get better at reading the writing on the walls and better at reading the numbers on the walls, but actually doing the writing. A better job in telling our story and making it compelling, because it is the story of Alberta, and in many ways it is the story of Alberta. And I brought a little story, and I've always wanted to do this. Unroll a poster in front of a room of 1,600 people. But I think you can see it up there. And this is our story at ATB. It's not a mission statement, it's not a vision statement, it's not a list of pillars and platforms, and there's no blah, blah, blah in it, and it's certainly not Kool-Aid that we expect ATB team members to be drinking. It's just our story, and it's what we see that is not quite right out there, and it's what we, and that includes me and Dave Mowat and my executive colleagues who are here today, like Curtis Stange and Lauren Rubis and Rob Bennett and Ian Wild and Chris Strachansky and Peggy Garrity, Bob Mann, Bob McGee, and 5,000 other team members at ATB across this province. It's what we're doing about it, and it's only 94 words. It's posted on a wall near my office, and it says that we can transform banking and reimagine it, make banking work for people, because we carry the outrageous belief that banking can change people's lives for the better, make their time richer, and their aspirations closer, and their happiness deeper. And how will we do this? And that's by doing things other banks wouldn't do, by being ever loyal to our customers and relentlessly inventive and steadfastly genuine in our pursuit of Albertans' greater good, by using banking to create happiness. And why happiness? Because it's good things happen when happiness becomes your purpose, and that's why ATB will always be more than a bank. And that is the ATB story. This is our DNA, and this is who we say we are. Where I work at ATB, it's about making your time richer is one of the reasons we even signed up to sponsor today. And I share the ATB story with you not in any way to be critical of anyone other than ourselves, because we are less than we can be. But I do share it to remind all of us that we are all the authors of the stories that shape us and shape what people see when they look at us, when they look at Calgary and when they look at Alberta, because we are the executive vice presidents, we're the presidents, we are the CEOs and chief people officers, we are the CFOs, and we are the directors and managers with all kinds of titles in this room. But mostly we are authors, because the East doesn't get to write our story. Politicians don't write our story. Numbers don't write our stories. Fate doesn't write our story. Everyone in this room, we are not just economic outlookers. And so I'm asking you, when you go back to wherever you go today, to start crafting our next story, a better story, a more positive story, an exciting Alberta story, because our story rates high interest. Because Alberta's story rates high interest. So with that, Stephen, Glen, Todd, thank you again for speaking with us today, and thanks to all of you for coming.
Thank you, Wellington. We have one last thing to do. We have two last things to do. Maybe first of all, we could just take the opportunity to thank the staff here at the BMO Centre for a wonderful lunch. And if I could please ask Greg Soretsky, President and CEO of WestJet, to come forward to make the draw. We've collected all your business cards here. I know there's a new flight to Houston, there's a new flight to London that WestJet's doing. It's all very exciting. This will be for 2 tickets to anywhere that WestJet flies in Canada. Hi, Greg. I'll hold it, you draw. It's pretty full. It's pretty full. Of 1,550 people, Maggie Schofield from downtown Calgary, Executive Director, you've won 2 tickets to anywhere WestJet flies in Canada. Congratulations to Maggie. That concludes our program for today. Remember to take that USB stick with you. It has all the information that you heard today. Thank you very much for attending the 2016 Economic Outlook. Enjoy your afternoon.